Okay, I think we're going to go ahead and get started now. Looks like most people have joined. A few more people are coming on, and that's fine. Let's go ahead and get started. Mike Toy here, National Brokerage. Today's webcast, we're going to be talking about GUL versus IUL, and I'm going to keep it kind of short and simple. I'm not going to dive into the weeds too much on either of the two options. Obviously, you can talk about IULs or GULs to death. You could really go into a lot of detail on either one, but that's not the goal for today. Today, the goal is just to identify the major differences between the two and to help you kind of identify which one is best for your client, depending on the situation. So some quick and easy ways to distinguish the difference and explain the difference to your clients. So let's go ahead and get started here. On to the next slide. All right, I'm going to start with a quick shameless plug here about ourselves. National Brokerage, we're life and insurance and annuities brokerage, providing the following: full case management, an application team, otherwise known as NBGO, that takes the application on your behalf, a dedicated marketing rep, such as myself, and a full back office with reporting analytics in your OES account. If you haven't followed us yet on social media, I would encourage you to do so. In particular, our YouTube channel is where you can get a lot of good tips on underwriting and other topics, and find recordings of all of these webinars. So if you haven't followed us yet, please do. And all of our contact info is on the bottom right-hand corner. So let's get started. GUL versus IUL. To start with, let's define what a UL is, putting the UL in these two. Universal life. It's typically considered to be permanent insurance and is an alternative to whole life insurance. So there's some ways that it's better than whole life, such as it has the potential to build up cash value more aggressively. It typically comes with greater flexibility, such as the ability to borrow from the policy or adjust the length of the guarantee, which we're going to talk about here in the next couple of slides. And in some cases, you can allow the cash value to pay the premiums for you. So some of those examples just named are ways that it has more flexibility than a whole life. So moving forward now. And I'll stop to answer some questions at the end here too. Like I said, this one won't take too long. So if you do have some questions, just jot them down, and then we'll get to them in the end here. So now that we know what a UL is, let's talk about some distinguishing differences between a GUL, or a guaranteed whole life, versus an IUL, or an indexed whole life. A GUL focuses on long-term guarantees. And what do I mean by that? You might be thinking, well, if it's permanent insurance, isn't it all guaranteed? Well, no, not necessarily. So that is one difference between these two, is that in IUL, you can adjust the length of the guarantee down further than you can a GUL. A GUL doesn't focus on cash value, so it builds little to no cash value. It focuses on long-term guarantees instead. On the upside, it has the lowest premium of all the permanent options. So unlike whole life or an IUL, a GUL is priced more like term, really. I've heard it called term insurance for people who can't get term insurance, maybe the older age clients who can't get a 20-year term. A GUL might be a good option for them. So to summarize that, low premiums, long-term guarantees, no cash value. Little to no cash value. And nowadays, many of them come with return of premium options. So ROP stands for return of premium. To give you an example, some typical options there would be in years 20 and 25, the client has the option to surrender the policy and receive all of their premiums back. Now, that's just an example. They're not all built that way, but it's becoming more and more common. So those are some common traits and features of a GUL. Moving on here to an IUL. An IUL, on the flip side, has a heavy focus on building cash value. That's its whole point, is to build cash value on a tax-deferred basis. Not tax-free, but tax-deferred. The index, in index whole life, is referring to the index for growth, usually somewhere between 0 and 10%. It can vary by product and by carrier, but that's a pretty good example there, 0 to 10%. So what that means is that your cash value rather than growing at a steady, let's say 3% every year, no matter what, like a whole life, this has a higher upside. You could gain much more, all the way up to 10%. On the flip side, it could also go down, but never below zero. So you might have heard the term zero is your hero. That's what that's referring to. So even if the market is tanking and the world economy is in shambles, the worst your policy could ever do is 0%. So it can't ever lose money. It just wouldn't gain anything in those years. Now on the flip side, if the world economy is doing fantastic and everybody is making money hand over fist, the best this policy could do is 10%. So it's going to stay within that range and that index. Now, one other thing that I'll point out that isn't listed here is that when we talk about the market and gains and losses, the cash value is not directly invested into the market. So that's something that's important to understand. It just mirrors the market. So it's important to point that out and to understand it, because a lot of people don't want their money invested in the market, so it may help them to know that. Moving on to the next bullet point here, flexible premium options. With an IUL, you can really design these a number of ways. And like I said, I won't dive into the weeds about all the ways to do it, but just to give you an overview or an example is, rather than a whole life, again, which has the same premium from day one till the very end, IULs you can design to pay heavier premiums in the beginning and lighter premiums in the end, or vice versa, depending on the person's situation. Maybe they want to pay higher premiums in their working years and lower premiums in their retirement years. With an IUL, you have that option to do that. And even in some GULs, but it doesn't work as well as an IUL because there's no cash value there to compensate. So those are some examples of flexible premium options. Now, one thing else that I'll point out, and it seems like this gets overlooked a lot, is that for an IUL to really work the way it's supposed to, it needs to be overfunded. What do I mean by that? Let's say we run an IUL illustration. Client wants $100,000 on an IUL. So you run the illustration. The minimum premium is, let's say, $200 a month. Well, they can pay that $200 a month, but it's not going to perform very well, meaning the cash value is not going to grow very aggressively. It's going to grow very minimally. So what you want to do is you want to say, okay, Mr. or Mrs. Client, we need to either A, pay more premiums than that 200 minimum, or B, lower the death benefit from 100,000 down to, let's say, 75,000, but keep the premiums the same. What that'll do is essentially you're putting more money into it now. It will build bigger cash value, which compounds and builds interest and performs the way you would want an IUL to perform. So long story short on that, an IUL really needs to be overfunded to work the way that you want it to work. Something else I'm going to point out is that an IUL typically has shorter guarantees than a GUL. So 20 years is kind of a default. I've seen them as low as 10 years by default. What that means is you can run an IUL, and it's going to show you 3 columns. It's going to say, here is the guaranteed rate that you can expect to get. For that, let's use that same example. For that $200 a month, $100,000 policy, if you paid that $200 a month, it is guaranteed to last at least 20 years. So as long as you pay that, it'll last 20 years. After that, they don't know for sure. They can't guarantee it. Things can change. Costs of insurance can go up. Maybe the market has gone down and it didn't build enough cash value to really help in those later years. So the premium might have to go up in order to keep it in force. So that's something to be aware of. And the further columns is going to show a more rosy picture and say, okay, but based on historical averages, here's what you can expect. The death benefit would last more than 20 years. Again, not going to dive into the weeds, just wanted to give you kind of an overview example of what that means. So always pay attention to the guarantees. So what does all this mean, really? Move on here. My slide will cooperate with me. It really just comes down to what is more important to your client. So if your client is, let's say, 75 years old and they They figure they're going to live another 20 years. They're doing okay. They just want to have some money put away for their, their beneficiaries. Which would be better for them, a cash value IUL or a death benefit guaranteed GUL? Probably the GUL, because A, there's not enough time to really build any cash value, and B, that's not their goal. So on the flip side, if they're 40 years old or 45 or 50 years old and they're in their prime working years and they want to plan for retirement or put money away for their kids' college, that type of thing, what would be better for them? Not necessarily the long-term guarantee, but a cash value IUL. So it's really the best way to figure out which of these two things is good for your client is to just find out what their goal is, what's most important to them. Is it building cash value, or is it just having that guaranteed death benefit for the long term? They don't want to risk paying more premiums later or losing the policy later. For them, go with the GUL. For everybody else, go with the IUL. But it really just comes down to finding out what their goals are and what they want to accomplish and finding out what is more important to them. So hope that sliding scale works there. Move forward. Some more good indicators to find out which one is best for your client. On a GUL, you would want to go with that if price is the main concern. So if they really just want to get the most death benefit that they can, they want to maximize the death benefit for the lowest premium that they can get away with, a GUL is the way to go, not an IUL. Anytime that you hear premium is the number one concern, steer clear of the IUL, because that means they're not going to be able to overfund it, so it won't perform the way that they want it to perform or the way that you would expect it to perform. Also, if they wanted lifetime coverage and that's their main concern, they're not concerned with cash value, GUL is the way to go. On the other hand, if they have other concerns, such as saving for retirement or their kids' college, indexed UL is all day long. An IUL is the vehicle for them, not a GUL, because a GUL won't build any cash value for that. If they talk about building cash value that's tax deferred and that appeals to them in IULs, that's another good indicator for an IUL. And minimum premium is not the main goal. If that's, obviously, if you bring it up, everybody's going to say, yeah, I want the lowest premium possible. But you'll get to know the difference. The ones that it has to be the lowest possible premium versus minimum premium would be nice, but that's not exactly why we're doing this. We're doing this for these other reasons. That's when you want to go with the indexed UL or the IUL. So, move forward here. And that really, for the most part, concludes. Like I said, I wanted to keep this one relatively short and just go over some of the basics of an IUL and a GUL, just so you can get a good understanding and be able to quickly and clearly explain the difference to your clients and know off the top of your head which one to go with given the situation. So that being said, let me see if we've got any questions here. Looks like we don't have any questions. So I guess if that's it, if we don't have any questions, then I'm going to go ahead and conclude the webcast. A full recording of this webcast will be on our YouTube channel, usually within the first 24 hours. So if you haven't added us yet, please do go and subscribe to National Brokerage on YouTube. You'll see this webcast and all previous webcasts that we've done before, as well as some other tips and tricks on for sales ideas, and underwriting tricks and tips, and some good tutorials on how to do certain things such as submit an NBGO case or fill out your e-contracting. So if you haven't added us yet on YouTube, please do. If you haven't worked with us yet and you don't have a rep, please give us a call, 1-800-377-6344. Just let the receptionist know that you need a marketing rep assigned to you, and she'll get you assigned to one. Otherwise, just give your marketing rep a call if you have any questions about this or anything else. I just want to thank you for joining the webcast today. Oh, it looks like actually I do have a question right at the last minute. Let's see. Question is, when you take a loan from the policy, does that not create a taxable event? Correct. The answer to that is that it could. It could. There are some circumstances where it could and others where it could not. But that is a great question, and it is something to be aware of. So thanks for bringing that up. Make sure that there's nothing else. Yeah, it looks like that was it. I would say give your rep a call on that, Seth, on that question, because like I said, there are some examples where it would and where it wouldn't. I don't want to steer you wrong because I don't know all the details of your situation there. So give your rep a call, and we'll go over some of the finer details. But thank you for asking that question. Any other questions before I wrap it up today? I'll give it just another minute in case anybody wants to type one in there. No, looks like that's it. Okay, everybody. Thanks again for joining the webcast today, and hope to hear from you soon. 1-800-377-6344. Have a good day, everybody.